Hello, thank you for joining us. Welcome to the Schulze Asset Management Investor Webinar for the first quarter, or for the final quarter of 2022. George Schulze, founder of Schulze Asset Management, and I welcome this opportunity to talk to you about the past year, what we are looking toward, and what's going on in our fund in that context. I'm Angela Louie. I am the head of business development and investor relations at Schulze Asset Management. Last year was a defining year in many ways. It was a terrible year for the S&P 500. We experienced one of the most precipitous rates rise since the late 70s, early 80s. And we've had one of the worst years for treasuries. It is clear that we are in a transition period. So what does this mean across assets and for distressed securities in particular? We'll spend some time today to talk about how no one here at Schulze Asset Management is sitting on the sidelines. This webinar is for investors only. So if you are press or media, please sign off now and contact us directly at investorrelations@samco.net. Give me just a moment to share our presentation. Okay. Can you see our presentation? Okay, I'm sorry. Were you able to hear everything I just said?
Yes, all good, Angela.
Terrific. Give me just a moment. This presentation is a summary of our views. The Schulze Asset Management 2022 fourth quarter report was just posted into our investor data room. So please download the full report there for a more detailed and expanded description of our discussion here. In the next hour, we will cover the market review for the last quarter and year. And we'll talk about what's going on with the Fed, with asset pricing, and with volatility for the rest of this year. As market uncertainty persists, the distressed security space remains an interesting place to find opportunities in these dislocated markets. George will walk us through some of the big movers in the portfolio and how volatility creates windows of opportunity for us in certain industries. We also want to talk directly with you, so please ask questions, type them into the chat box, and I will read them out loud. Now, if you like to ask the questions yourself in your own voice, we'd love to hear from you. So type the word live in front of the question, and I will unmute you. And we will get to all of these questions at the end. Let's begin with performance. For 2022, the fund outperformed broad markets in the fourth quarter and in the full year of 2022. The fund generated a net return of negative 11.5% for the year and positive 10% for the quarter, with the liquid share class down 1.6% net for the year and up 13.2% for the quarter. Even with the fourth quarter recovery, 2022 was a challenging year. S&P 500 has had the worst year since 2008, down 19.4%. The Russell 2000 was down 21.6%, and the NASDAQ was down 33.1% last year. A convergence of factors led to stress on the global economy and markets, and we see this with the MSCI World Index down 19.5%. Inflation, recession fears, and concerns over the monetary policy are driving the market uncertainty as investors struggle to see where we will land in this transition period. In this environment, healthy portfolios should have short sales and short duration long investments. We are finding over-leveraged and overvalued companies that will now face a harsh operating environment likely to cause their stock to drop. This economic uncertainty and the likely recession are causing even further market dispersion. So what makes us so excited about this environment? Well, we're finding interesting investment ideas in unconventional places, which we'll talk about in just a moment. Our core focus is to invest up and down the capital structure and long and short of equity. We also manage risk using deep fundamental research, limit our leverage, and size our positions appropriately and adhere to our stop loss guidelines. A lot of people are talking about the inverted yield curve today. The chaos within fixed income was worsened by tightening monetary policy, inflation, and the increasing risk of recession. Now, historically, there is a tight correlation between an inverted yield curve and the risk of future recession. This graph is so crucial to thinking about today's sentiments, and George will dive a little deeper into this.
Thanks, Angela. I hope everybody can hear me well. Thanks, everybody, for dialing today. So yeah, the inverted yield curve, lots of people, lots of market commentators talk about this as a leading indicator. Its primary value is predicting the risk of a future recession. And the reason that's the case is because, you're really talking about market prices for money over a short period, midterm period, and long-term period. And if you think about it, the biggest players there historically have been banks. They lend money long-term. You get mortgages or auto loans or even credit card debt from banks, and they finance that with short-term borrowing, which is deposits, really daily deposits and weekly, monthly deposits, et cetera. And so in a normal environment, because of the time value of money, this yield curve should be upward sloping. That is, for short-term money, it should be less expensive than long-term money because of the risk of inflation and because of the time value of money. And typically market participants will drive the yield curve to look like that, except during times like right now, when people are so concerned that there's going to be a future recession that they believe the Fed will drastically reduce rates in the future. Now, there's some good debate we could have about that, whether they're right or whether they're just being speculative, or maybe because so many treasuries have been purchased by the Federal Reserve in the last year or last several years. Remember, the Fed's balance sheet got up to $9 trillion. That maybe this indicator is losing some of its value. But if it isn't, then there's an arbitrage profit opportunity here, because you can basically take a view that longer term rates will rise or shorter term rates will drop, and eventually you'll get back to a normal yield curve over the cycle. But clearly it's flashing red right now. It's this and actually most economists agree that there's a risk of recession coming either later this year or into next year, and there's a variety of reasons for it.
So let's take a more detailed look on just that point. Here are some macro readings. Real GDP growth is at 1%, unemployment at 3.4%, inflation moderated to 6.5%, and the Fed funds rate is at 4.6%. We have a contractionary monetary policy with an expansionary fiscal policy. So on the one hand, interest rates gapped up dramatically from 0.1% in December 2021 to 4.625% today. The large increase in benchmark rates drove widespread losses across fixed income markets. On the other hand, fiscal policy remains expansionary through the infrastructure bill, the CHIPS Act, the CHIPS Inflation Reduction Act, and the size of the Fed's balance sheet currently at $9 trillion. Most economists forecast a recession, just as we spoke about this in the previous slide, this year and next year. We expect that the Fed will stop hiking rates after it gets to 5.25, 5.5. However, persistent inflation readings will make it hard for the Fed to reverse course. As I indicated earlier in the macro reading, modest GDP growth, record low unemployment, and expansionary fiscal policy all point toward optimism. optimism. However, risk-taking is pulled back due to inflation and losses in 2022. Now, let's talk about what this means for our portfolio right now and how we're positioned against this backdrop. Our long portfolio is at an average of approximately 2.7 times enterprise value to EBITDA versus the S&P 500, 12.9 times. And our short portfolio is at 163.7 times enterprise value to earnings. We employ hedges against the risk of market corrections and inflation, so it's worked really well for us. Now, this is a great time to hand it off to George. George Schultze, again, is the founder and managing member of Schultze Asset Management, and he'll talk about default trends, our portfolio highlights, distress trends, and some of the big movers in our portfolio. Just a brief background, George chairs our investment and strategy committees. Before founding this firm, he was at MD SAS, Fiduciary Partners, which is a fund to fund, and Mayer Brown and Platt Law Firm and Merrill Lynch. As a reminder, please, if you have any questions, type them into the Q&A box at any time, and we'll get to all of them at the end of the presentation, but we'd also love to hear your voice. So if you're willing, type the word live in front of the questions and I will unmute you. Hi, George.
Hi, Angela. Great, thanks. Thanks again, everybody, for dialing in. I hope everybody can hear me. Angela, let me know if there's any issues with the audio. Yeah, this slide on page 6, it's from the Federal Reserve Bank of New York, and it shows at a high level what's happening in distress land. Clearly, we've entered a period in the economy where you're seeing more and more distress for the reasons we talked about in the last few pages, due to inflation, due to higher interest rates, due to tighter monetary policy, including quantitative tightening, and also just due to market volatility. And then, of course, some big structural concerns behind the scenes, like the war in Ukraine and the challenges with supply lines, dating back to COVID and before that. So you're clearly seeing an elevated new level of distress. Most people that follow this market, including JP Morgan, are forecasting defaults and the default rate to climb over the next 2 years. And really, I think it sets up for us as a great opportunity now to focus more on short selling and eventually, invest more in long distressed debt positions. But there's also a good opportunity right now, we believe, in owning post-distress equities that have interesting near-term event-driven type catalysts. And we'll talk about some of those in the next few pages. One other new major development in distress land, for those of you who are wonky nerdy about it like I am, there was a big case that was recently dismissed in Texas. I'm sorry, not in Texas, but it's called the Texas two-step. This is a bankruptcy scheme that Johnson & Johnson recently tried, and other companies have tried and used this, I call it a scheme, because really that's what it is. The way it works is a company that's facing mass tort liabilities, and torts, for those of you who, for the uneducated or non-legal people on the call, those are lawsuits, personal injury claims against a debtor in possession, a company that's operating. In this case, Johnson & Johnson, a very well-known company that invented the Band-Aid and sells talcum powder and lots of other pharmaceuticals successfully, has seen a greater and greater incidence of asbestos-related claims against it due to sales of talc. And asbestos claims have a history of driving companies into bankruptcy. And so what Johnson & Johnson did, and what lots of other debtors like this have done over the years with mass tort claims like this, is they performed this Texas two-step bankruptcy scheme. And that is, the parent company separates into two entities. One, call it Good Co., continues to run the business, and the other, call it Bad Co., is burdened with the liabilities. However, it's also funded with cash to settle those liabilities over time. In this case, Johnson & Johnson formed a new subsidiary called LTL Management, and their goal was to have that subsidiary be solely liable for all these asbestos claims related to talc sales, and that entity filed for bankruptcy, thereby completing the so-called Texas two-step. You can just picture the square dance that occurred. Big news, new law here. The appellate judge dismissed that bankruptcy filing and held that because this debtor is not in financial distress, and it takes financial distress for a debtor to be able to file bankruptcy, LTL was not allowed to remain in bankruptcy, and the case was dismissed because it had received a financial backstop of almost $62 billion from Johnson & Johnson. And so this is new precedent. And other bankruptcy courts will have to look to this unless and if it's appealed successfully. But the bottom line with this new precedent in distressed securities land is that other companies with mass tort liability are more likely to file bankruptcy, and you'll see just even more distress because of this alone. It's an interesting backdrop with the Texas two-step change, and that'll apply really across the board for other companies that face mass liability, including opioid producers like Teva Pharmaceutical, potentially, Endo Pharmaceuticals, which is in bankruptcy right now, and Mallinckrodt, which recently went through bankruptcy. But here on page 7, you have the list of themes and sectors that are currently seeing distress. It's a large but growing universe. In the airline space, you have something very interesting. Two companies that were distressed during COVID are looking to merge, Spirit Airlines and JetBlue. However, there's a new sheriff in town with the antitrust regulator in the US, and so we'll see if that merger occurs or not. In the automaker space, you have a number of post-distress companies, but you also have massive secular change. Two that come to mind are General Motors and Stellantis. We'll talk about Stellantis later today on this call, but these companies have really navigated the secular changing environment quite well, and they've invested a lot in new EV vehicles, and we'll discuss that briefly with Stellantis in a few minutes. With casinos, Caesars Entertainment was the largest bankruptcy of all time. It's trading as post-distress equity now. There's some new themes with MGM and Wynn, lots of companies that have Asian operations in Macau specifically. There's been a reopening trend there. And so some of these companies that operate there, including MGM and Wynn, were faced with risk of distress, but now there's an interesting reopening trade with China, no longer mandating COVID-related lockdowns. We'll talk about coal also in a few minutes with Alpha Metallurgical, but there's a lot going on in that space. Just looking back 4 or 5 years ago, basically every coal company was bankrupt. These days, you have good coal companies, the ones that produce met coal, metallurgical coal, and then you have the bad ones that produce steam coal. But they're all making money, and for a long time, nobody wanted to touch them with a 10-foot pole. Turning to crypto, you'd have to be sleeping under a rock to not know that there's been a big blow up in this space. The biggest bankruptcy there was FTX. There's allegations of fraud. There's lack of transparency. Really, it's a Lehman moment in general for crypto companies, and we expect more distress in that space. So there's really, as you can see, there are examples in every one of these sectors. In energy, there's Chord Energy, Chesapeake, Whiting Petroleum. In financial services, companies like Bank of America, went through distress and now are generating higher and higher net interest income. In governments, you still have Puerto Rico working through the biggest municipal bankruptcy of all time, and interesting opportunity to invest there through MBIA, which has exposure there. We talked about litigation, so I won't talk about that much more right now, but getting down to retailers, lots going on there. Bed Bath & Beyond was right on the verge of filing for bankruptcy before they got rescue financing. A company called Mr. Car Wash seems like it's positioned kind of poorly. Another one, Supercuts, positioned very poorly. So lots of change in the retail space, and mostly secular change. That is where companies that have brick and mortar locations with landlords and leases, positioned just much worse than the new economy companies like Amazon, who ship product through the intranet. So again, I could go on in this list for a long time, but just in the interest of time, maybe we'll just move forward. So a couple quick portfolio highlights. Angela alluded to these before. Our fund, we weren't pleased with the returns last year, obviously. Great that we beat all the indices, but we'd like to do better, and we think we're on track to do better. By the way, so far this year, we're up almost 7% so far, a month and a half in, year to date in 2023. But I think it is important to note that our liquid share class, the one that has quarterly liquidity, was down only 1.6% in 2022. And it had a big rebound in the fourth quarter, up 13%. You see the index returns, fixed income indices were down too. It was pretty much a global rout. But this should be a time, I think, going forward where a fund like ours can outperform. Now, our portfolio is very cheap, only a 2.7 times EBITDA on the long side. And on the short side, it's about 160% or 160 times. So you can imagine versus the S&P, which is about 13 times EBITDA, where the opportunity is here. In the quarter, our best performers were Alpha Metallurgical, MBIA, PG&E, Revlon, and Stellantis. And our worst performers were Clever Leaves, GTT, Mallinckrodt, McDermott, and Windstream. And so we'll go through some of these names in a few minutes. If you look at our quarterly letter, each of them are described, much more fully. So on page 9, just a couple more comments about the portfolio at a high level. We had a good win-loss ratio in the fourth quarter, 2.7 times. Proud of that. And by the way, we generated gains both in longs and in shorts, which is unusual. You can see that in the first column on the right. Post-distress equities represented 82.2% of all of our gains, even as short stock positions generated nearly 40% of our gains as well. So very proud of that. I think one of the things we did best, and this holds true in all of our history, is that we exited underperforming shorts quickly and refocused that capital on performing positions, but we also did it with longs. And usually in our best years and best periods, when we achieve that very well, it sort of helps drive better returns due to the 80-20 rule. So again, did very well in the fourth quarter. I think we could have done much better in the full year. But again, just looking forward, I think we're on track to do very well this year. So, so we're excited about that. Okay, turning to some of the top positions that had notable events during the quarter. The first is Alpha Metallurgical. This is a coal miner focuses on metallurgical coal, operates 19 met coal mines in the US. This business restructured in 2016 and eliminated almost $8 billion in debt. Now, for those of our investors who don't know yet, we've been talking about this one for a while, but met coal is a crucial feedstock for making steel. And this company is recently a pure play producer. It has a great balance sheet, actually has more cash on the balance sheet now than debt. It has also substantial tax assets, NOLs, almost $2 billion worth, which will help offset cash taxes for many years going forward. It's the largest met coal producer in the United States. And so met coal prices rallied last year due to inflation, but the war in Ukraine boosted them even further. And going forward, we expect that two additional macro themes, that is the US infrastructure spend, as well as the Chinese reopening, will drive even more demand for steel and met coal. So last year, this company repaid all of its remaining debt. They grew their stock buyback authorization to $1 billion. And so now the number of shares outstanding has dropped just to about 15.6 million shares. In December, they paid a one-time special dividend of $5 a share, and they increased their quarterly dividend to almost 42 cents a share. This company is just printing cash. Times are good. They're expected to continue to be good going forward, but the market still doesn't get it. And that's why the board and management is involved with these event-driven type catalysts of buying back stock, increasing in special dividends. But it trades at 1.3 times EBITDA. It's trading at about 167. It's up a little bit today on the news of some of its peers reporting great earnings. Our goal for this stock is over $250 per share, which would be another 50% increase from here. And our cost for AlphaMet is actually in the low single digits. It's been a great position for us, and we're excited about the outlook for AlphaMet. PG&E. This is maybe a little bit more of a well-known company. It's a major utility in California. It's among the largest in the U.S. It came through a restructuring in 2020 after major forest fires put it into bankruptcy in 2019. Now, we've been investing in this company long and short for years. Back in 2001, this company went through its prior bankruptcy and settled about $10 billion in liabilities back then. Anyway, it came through bankruptcy again, call it Chapter 22, if you will, in 2020, and settled nearly $26 billion of debt and wildfire claims. It was one of the top 10 bankruptcies of all time. And in its plan, there's a number of things that happened here. Wildfire claimants got $13.5 billion. That was split about evenly, almost $7 billion each between cash and stock. The stock was put into a settlement trust, which holds about 24% of the company's new common stock. And by the way, similar to AlphaMet, through this bankruptcy restructuring and the way it was carved up, this company maintained, in this case, massive tax assets. So it won't pay cash taxes for many years. In fact, as and when the settlement trust sells more shares, it'll generate even more tax loss carryforwards because those shares are those sales are deductible to the company when and if it sells them. So that's it's very interesting. It's a kind of almost like it's operating in a tax-free jurisdiction. The company's on track to achieve earnings guidance, and they've done a good job, the management team, since bankruptcy, reducing future wildfire risk. They'll also benefit from new legislation in California called SB 998, which will mandate the undergrounding of future or of all electric transmission lines over time. And customers of PG&E will pay for that expense. It's a big expense, but it can be settled via securitized future revenues from customers. So despite all those good things with PG&E, which is really, has cleaned up its act now, is positioned well in a large economy state where the demographics are strong, the business trades, having said that, at only 9.5 times EBITDA, even though its peers are closer to 13 times. And we think it'll benefit from that discount going forward. It trades at about $15.80 a share. And our target for PG&E stock is 30. So that'll be another 90% appreciation as and when it gets there. So Revlon, here's a short sold name. We've been in and out of this position for some time. In the past, we've had to cover it as it rallied despite terrible fundamentals. But we recently, in the fourth quarter, reestablished a short in Revlon stock because it became more and more clear that shareholders would be wiped out. I think most people on this call know the business. It sells cosmetics and beauty care products. It was founded in the 1930s and was run and controlled by Ron Perlman for many years until last June when it filed for bankruptcy. And the reason it filed for bankruptcy, Revlon, is a couple things sort of converged. It was too much leverage, it was COVID, and it was global supply chain disruptions. By the way, as often happens with big, aggressively financed acquisitions, this business acquired Elizabeth Arden, one of their competitors. They paid $1 billion for it. They kind of paid it's kind of a toppy price, and financed it mostly with debt. So those several factors sort of combined and converged at the same time and drove it into bankruptcy. with nearly $4 billion in liabilities subject to compromise. Unfortunately for Revlon, shareholders and claimants, the business is doing only about 300 million of EBITDA per year, so it's excessively over-levered. And interestingly, its stock has rallied on and off. It's been called a meme stock, but I think we positioned it very well, shorting it after it had filed for bankruptcy, and as the meme stock rally had really ended, as the company was finally delisted from the New York Stock Exchange. So Revlon's current plan of reorganization, there's a restructuring support agreement. It will probably emerge from bankruptcy by June of this year. Includes a $650 million backstop rights offering. Pre-petition shareholders will lose their entire investment. They'll get zero. Even so, the stock's still trading at about 70 cents a share. So there's an opportunity for 100% return on short selling that stock. The plan includes a toggle, which allows another scenario if bidders come forth and the whole business gets sold. But it seems to me pretty unlikely that that's going to happen, especially due to all the litigation and uncertainty that's surrounded Revlon over the years. The latest dispute was that the 2016 term loan lenders filed a lawsuit, an intercreditor dispute against what's known as the Brandco lenders, claiming they acted in bad faith and were working with Revlon to file a plan of reorganization that unfairly gerrymandered the planned voting process. This is the second big lawsuit that the term loan lenders, the 2016 term loan lenders, have filed. The first one, they filed claiming that that Brandco lenders were not allowed to get the security that they did when they did the financing under the Brandco subsidiary. And that case was actually just dismissed yesterday. So that's a big development in this sort of intercreditor dispute case. Anyway, we think eventually that these two sparring lender groups will settle their ongoing litigation. If not, it's going to be forced upon them. It was a big loss, I think, for the 2016 term loan lenders to lose their case yesterday, the first case. The second one, which is focused on gerrymandering and extending the exclusivity period in bankruptcy. I think the 2016 term loan lenders are probably worried that the judge is going to dismiss that too, but more likely there'll be some sort of settlement. Either way, shareholders will get nothing, pre-petition shareholders, and so we're going to stay short that stock and look for a full 100% return when it's canceled later this year. On the other hand, there might be some great new opportunities to buy Revlon's soon to be issued new public stock, and we'll be looking at that as and when the company comes out of bankruptcy. So switching gears to the automotive space, as it were, the final one I'll talk about here is Stellantis. It's another long post-distress position. Did pretty well in the fourth quarter, up nearly 20%. I think most people on the call probably know this business. The history with it is Fiat Chrysler merged with PSA Group in 2021, and the business was renamed Stellantis. This merger created the third largest automaker, with pro forma sales and EBITDA of about 150 billion and nearly 25 billion respectively. So the business's predecessor business was formerly known as Chrysler, became distressed during the 2009 great financial crisis, and we had a big investment actually in their first lien debt. There was a difficult restructuring plan forced upon first lien lenders at the time, and we actually fought the case all the way up to the U.S. Supreme Court. But at the end of the day, Fiat was able to buy that business out of bankruptcy, effectively for zero, just by assuming its legacy liabilities. Along the way, after that merger, Fiat spun off to shareholders its Ferrari business, and it also paid out over $3 billion in special dividends before finally merging with PSA Group and then being renamed Stellantis. So a lot of events here, looking back, in history, and more going forward. After Stellantis was formed, it spun off Faurecia, which is the 7th largest global auto parts supplier. And really combined, these two companies, they offer a multi-year restructuring story. We expect that the stock price will re-rate upwards as it continues to achieve synergies driven by these two complementary firms. They're estimating, management estimates about 3.2 billion in merger synergies. The company is actively launching and releasing new EV brands. It has 34 available already, and 17 new ones will be launched between the 2023 timeframe. But in terms of future events, they already have a capital allocation framework in place, which calls for a 25 to 30% dividend payout ratio, as well as a stock buyback for up to 5% of the issue. Excuse me. So these are very good fundamentals for Stellantis, despite the fact that we're kind of late in the cycle and that there is risk of recession. Despite that, the stock looks extremely cheap at just 0.3 times EBITDA. And so we're excited about the upside for Stellantis. It trades at about $17 a share, and our target is 35 or more, which would be at least a 51% appreciation from here. Angela?
Thank you, George. So it was a very challenging year, as you've heard, despite a decent rebound in the last quarter of 2022. To repeat, the Russell 2000 was down to 21.6%, S&P 500 down 19.4%, and the NASDAQ was down 33.1% in the last year. Our fund was down 11.5% for the year, while being up 10% for the last quarter. We hold, as you can see, we hold high conviction trades, which is crucial for the health of any portfolio, especially in times of high volatility. Our long portfolio is at an average of approximately 2.7 times enterprise value to earnings versus the S&P 500 of around 13. Our short portfolio is around 157.5 times enterprise value to earnings. Now, interesting lessons and wisdom come from managers who have long track records and have weathered different cycles. So viewing this cycle through the lens of such of an historian can give you insight into present day dynamics. So as an experienced investor, we are sorting the investments by asking questions like whether companies today can defend their liabilities and build a portfolio that will adapt and survive. We're celebrating our 25th year anniversary, and we're very excited about this outlook. We have our annual returns here on the slide to make it easier for everyone to see. But our monthly returns, which is it's a couple of pages, are available to anyone who's interested in our investor data room. Now let's take some questions, and I'm going to bring George back on the screen to answer. Hang on just a moment. Terrific. So we've got, thank you for sending in your questions. Okay, so here's our first one. Can you tell a little bit more about the PG&E slide that you were talking about? How did you mess through that restructuring?
Sure. If you want, Angela, I don't know if it's easy for you, want to go back to that slide, you can point it out a little bit more again.
Maybe just a few seconds to go back to that slide. Okay. And
yeah, that's actually a very interesting case. I mean, for a big company like this to go through bankruptcy twice, it's a big deal, obviously. And both times it was, among the top 10 bankruptcies of the day. But with the first PG&E bankruptcy, we short sold their equity, and we did it again with the second PG&E bankruptcy. But then with the second one, it became clear at one point that it looked like shareholders would get a pretty good recovery, which is unusual. And so we changed our focus with the second bankruptcy. With the first one, we eventually just covered our short. And I believe we made some pretty decent money. The second one, we made pretty decent money in the short as well, but then eventually we changed the position and went long. But we did it mostly through a backstopped PIPE, which is a private investment in a public company, which was, we joined the syndicate that helped backstop the exit of PG&E through bankruptcy. And that gave us an interesting opportunity to buy stock at a discount to the public market price. All along the way, we spent a lot of time doing fundamental analysis, but I think we definitely had an edge in this case, not just having looked at it, a good 10 years before when it first filed for bankruptcy, but also, sharpening our pencils and getting up to speed when we were short selling it before I think a lot of the other long investors came in. So I think we had a big edge there.
Perfect. Thanks for all the questions. So here's the next one. Hi, George. Does the shipping industry look interesting given upcoming regulations?
Yeah, good question. There are a lot of changes happening in shipping. And it depends, like you almost have to sort of separate it out by segments. There are US-based shipping companies, Jones Act operators, which are regulated by the US market, and they're traditionally they have higher costs than other shipping companies that operate internationally. But even within that market, you can, there's a big difference between those companies that ship or service the oil and gas and energy markets versus those that ship grains or other products. But yeah, there have been some big changes. I would say upcoming regulations, the biggest ones have to do with environmental changes, and the companies that have older ships that haven't been able to invest in retrofitting them to the new ESG type regulations, they stand at a big disadvantage. But the ones that have good balance sheets and financial flexibility, they are at a big advantage because some of the markets in which they operate, for instance, like renewable diesel fuel or green type fuels are really growing, and so it's an area where significant fundamental analysis can pay off. There'll be opportunities to short sell those that are over levered or facing risk of future bankruptcy, but also opportunity to go long those that are cheap and that might have some interesting events related to them.
George discussed the best performers. Can you also discuss your ongoing convictions on 5 worst performers?
Sure. Yeah, good question. Let's turn to them, please, if you want, on the page. So we list them on page 8 as a reference point. And the worst performers were Cleverleaves, GTT, Mallinckrodt, McDermott, and Windstream. So generally, the way we run our portfolio on the liquid side is we look to exit positions when they hit our risk guidelines. And that's the 80-20 rule that I'm talking about. For the best investors, history has proven that the faster you get out of underperforming trades, the better. That way you can redeploy capital to the smaller universe of positions that are making you money. However, that's not always the case with private equity or less liquid positions. For instance, Cleverleaves has had a bit of a lot of changes. It's a new company that's finding its way in the public markets. There's not much more I can tell about it on this call because I'm chairman of the board and it's a publicly traded company, so I can't give special information about it on this call. But I would say that I'm optimistic about its outlook. For some of the other ones like GTT, and you can see this in our quarterly letter, we sold that. That was a small position in the company's distressed bonds. As they went against us, we sold them. Mallinckrodt, we owned post-distress equity as well as newly issued debt that came out of the bankruptcy. Well, we've sold off our equity, and even though it's cheap, it's sort of underperformed and hasn't really found a good stable place in the market yet. However, the debt has just an unbelievable yield. I believe the yield for Mallinckrodt debt is like it's almost a 30% yield to maturity. So I think that's a great opportunity. McDermott is a bit of a turnaround, and that's a little bit less liquid. Great business, private, but it does trade. It operates in the energy services business. They do, all sorts of big infrastructure projects, and I'm very optimistic about the outlook for that business. Very high conviction. With Windstream, it's been a little bit more challenging, and really just because the business is kind of hanging in there. But there's a lot more detail about all of these in our quarterly letter. So thanks for the question. I would encourage you, if you have time, take a peek at the quarterly letter. And if you want, we can have a follow-up call afterwards to discuss any of the names.
Sorry about the muting. George, how do you manage the risks of meme stocks?
That's a new theme these days, isn't it? Yeah. So thinking about this, and we talked about Revlon, which became a meme stock. But really, the thing about meme stocks is they're not really new. It's only the term meme stock that is new. It used to just be known as short squeezes. And in prior cycles, we've seen a lot of short squeezes over the years. Having done this for over 25 years, you'd have to be sort of sleeping under a rock to not have witnessed any short squeezes. And like the one I think about most often when I think about meme stocks, just going back historically, is a company called Globalstar. Years ago, we had a short position in a company called Globalstar. They were a new satellite, communications company that had overspent on building out their network, had zero revenues, and when they did it, they funded it all with debt, and they were forced into bankruptcy. But along the way, that stock had meme stock characteristics. It would rally from $1 or $2 a share up to over 30, I believe, and it caused great consternation for people who were invested in it and shorted it, including us. So I think the important lesson with meme stocks and short selling companies facing financial distress is that there can be a lot of volatility. So you have to position the size of the position carefully. It's very important also to have a good prime broker that you work with, and to make sure you're able to get the borrow, that the cost is reasonable, and that it's a stable borrow so you don't get bought in. But fundamental analysis is key. And I think lately, sort of the most important thing to help eliminate meme stock risk is just knowing that the company's either headed into bankruptcy in the very near term, or will be delisted one way or another in the very near term. And that's what we saw with Revlon. It was a meme stock until the day it filed for bankruptcy. Then it was kicked off the New York Stock Exchange, and it no longer had the ticker symbol REV. As happens with most bankrupt stocks, they tack a Q at the end of the symbol after that, and it trades over the counter, but that's not available for short selling for most meme stock traders with their Robinhood accounts and wherever else they have those accounts. And so that was the sort of the end of the meme stock rally. It's where meme stocks go to die once there's a bankruptcy.
Thank you, George. How do you manage all of the flow of information and updates that's coming into all of the investments that you're monitoring?
Thanks for the question. I would start by saying it's a great team that we have built it up. We've built up the infrastructure, I think, really nicely over the years. We've got a good standardized process in place as well. We have I think it's about 4,500 companies now that are in our database. And we look at them and perform valuation analysis on them all with a standardized template, which I think, having that process in place and having honed it over the years, I think gives us an edge for managing just a ton of information and ideas that come through that funnel. But some of it is automated. Working with Bloomberg, for instance, when there's a bunch of companies reporting earnings, each earnings call automatically populates in my Outlook calendar as well, and as well for the other people on the investment committee. So I would say that's the main key here.
Terrific. Here, let me share this. So we are at the end of our presentation. Here are some macro points I'd like to leave you with. As markets become more frenetic from the rising interest rates, it is punishing US companies and global companies that have accumulated a debt mountain, much of it in the past decade when the Fed kept interest rates at near zero. This will drive a divide between companies who can cut debt to survive and those who can't. This can mean an extended cycle of stress and distress companies in the pipeline. So we're very excited about this new time that we're facing. And I just want to say thank you to everyone for your time. Success here at Schulte Asset Management is not measured in months or quarters, but rather by the long-term success of our fund investors. I'm Angela Louie, and this is George Schulte. We wish you great health and a smart and successful investing. Bye-bye.
Thank you.